Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. For the second month in a row, the Reserve Bank Board has increased the official cash rate, but this time, the central bank surprised economists with a 50 basis point jump. It's the biggest single increase since 2000, taking the cash rate to 0.85%. We're now left with plenty of questions. What impact will the increase have? How many more can we expect? And will it be enough to get inflation under control? Gareth Aird is Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
G'day, Sean. It's nice to be here.
You had a busy day yesterday, I'm imagining.
Oh, look, I did, and many of the market did. The decision by the Reserve Bank to increase the cash rate by 50 basis points caught almost everyone by surprise. I say almost everyone. There were actually a couple of analysts out there who did pick the 50 basis points. But in the main, most people were thinking either 25 or 40. We thought they'd do 25 at Commonwealth Bank, given that's what they did last month. And they said that was business as usual. And we thought if they were going to not do 25, they might do 40, given they flagged to us in the May board minutes that they had considered 40 basis points. But look, to come out and do 50 basis points, I thought was a very big deal. And I think it also tells you a little bit about where their headspace is and how quickly now they're going to move to try and put downward pressure on inflation, which I think actually changes the growth outlook.
Okay, so there's a bit to unpack in all that. The Reserve Bank seemed to be fairly confident about inflation until the last few months, really, and now it seems to have flipped totally. Why did it go 50 basis points yesterday, do you think?
You're right. They've changed their assessment on the outlook for inflation very, very quickly. They've gone from pretty much all of last year and earlier this year to telling us they wanted inflation up. And their concern was that it wouldn't be up in a sustainable way because it wouldn't be accompanied with higher wages growth, and therefore they were going to wait until the last possible minute to raise the cash rate. And now, having increased the cash rate in May, they've now accelerated the size of the rate hike to 50 basis points, and they're talking about needing to get inflation down and the board being committed to doing what is necessary to ensure that inflation returns to target. So it's a really radical shift in a very short amount of time. I think it wasn't actually necessary to make such a radical shift. I think 25s from here would have sufficed because the Australian household sector is very leveraged and they'll get a lot of mileage out of rate hikes. And there's already a few cracks appearing in the data. Consumer confidence is well below average levels. Our card spend data at the bank suggests that spending momentum has slowed quite a bit in the last 5 weeks, and home prices are already coming off. So I think the case was actually stronger just to keep the business as usual 25s going for a while. But clearly the Reserve Bank doesn't think that way, which is really what matters in the end. It feels like they're in the same place now as the Fed, the RBA, the Bank of Canada, where they really want to run hard now against inflation. And I think that does actually alter the growth outlook because, the harder they go in terms of rate hikes, the more that's going to weigh on consumer spending. In time, it'll weigh on inflation. It won't weigh on inflation straight away. But I do think now it's actually starting to change the picture as we think about how the economy will evolve from here.
When I studied economics many years ago and they talked about the transmission mechanism of monetary policy, it was something like 18 months where the full effect of higher interest rates or lower interest rates was supposed to hit the economy. What you just said then suggests that even if it's not the interest rates, perhaps it's the expectations of higher interest rates or something seems to be hitting the economy pretty quickly.
Yeah, look, it's a good point. I think the lags between changes in the cash rate and the impact on the economy are now a lot smaller than what they used to be. And you can see that in the housing market. Historically, if we look back at previous tightening cycles, home prices have been rising into the tightening cycle and then they've kept rising as rates have gone up. And then it's only after several rate hikes have been delivered that home prices start to slow. Whereas this time around, we've had one rate hike and home prices are already coming off. And I think they'll actually come off quite quickly from here. And a key reason here, I think, as to why the lags between changes in the cash rate and the impact on the economy and the housing market and consumer psyche is far more immediate, is that households simply carry so much more debt than they did previously, which means they're way more exposed to a rate hike than ever before. And then on top of that, because the starting rate is actually so low, the percentage change in the rate is actually very, very big. So to put some context around it for the listeners, I mean, if you went from an 8% mortgage rate to a 16% mortgage rate, that was a doubling in your interest cost on debt. it's going to be the same going from 2% to 4%.
Yeah.
So I think the reason that the lag between changing the cash rate and the economy will be a lot shorter now is simply these rate hikes will be quite powerful. And it's one of the reasons why we thought they didn't need to be too heavy-handed about pushing the cash rate up quickly. But 50 basis points is a big increase relative to the average mortgage rate right now. And I think lots of households out there will find that the interest cost on their debt goes up quite quickly, and their mortgage repayments are rising quite swiftly. And that means they'll need to look at where they're spending money and make some adjustments around where they're spending money. And of course, that has an impact on the economy, which is why we're going to be downgrading our assessment for the economic outlook based on where we think the RBA is going to take rates this year.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Head of Australian Economics at the Commonwealth Bank. Okay, so where do you think the RBA will take rates this year, and what is your assessment of the economy now then?
Well, having delivered 50 basis points, we think they'll deliver another 50 basis points in July. Then we've got 25 penciled in there for August, but I think there's a risk that we get a big Q2 CPI number and they want to deliver another 50 basis points. That would be very aggressive tightening. And then we've got a couple more 25s over the second half of this year to see the cash rate end the year at 2.1%. And the risk there is that they do a little bit more and take it to 2.35%. You get those numbers assuming they deliver multiples of either 25 or 50, but no one can be too sure on anything at the moment. What we think for the economy at that point then is that the Reserve Bank has actually taken policy to a contractionary setting. So we think about interest rates as either being stimulatory, neutral or contractionary. Mm-hmm. And we think that neutral rate in Australia is very, very low, somewhere around 1.5%, given how much debt the household sector is carrying. And we sort of run some sensitivities to say what kind of changes in the cash rate, what will they do to mortgage repayments as a share of income? And when the cash rate is around about 1.5%, mortgage repayments as a share of household income will go back to a 20-year average. So our thinking is that any interest rate or cash rate above that level is actually contractionary. And that's then when you're talking about monetary policy slowing the economy down and generating an increase in unemployment, which we think will start to come through this year. So without kind of getting too cute on it here, we've actually put out a call now today that we think the RBA will end up taking the cash rate back down in late 2023, simply because it looks like they're going to front load the tightening cycle such that the economy will probably be slowing quite a bit now into 2023.
Okay. One of the comments that the Reserve Bank Governor Philip Lowe made yesterday is that he expects price inflation to get worse before coming back to the 2 to 3% target range. How does that fit into your scenario there?
Well, look, it will get worse, and it didn't matter what the Reserve Bank did yesterday or what they're going to do in the next month. The inflation that we're going to see for Q2 is already baked in there. Yeah. And there's nothing that the Reserve Bank can do to run harder against higher energy prices, higher oil price, or higher food prices as a result of the flood. And all of that is going to be picked up in the near-term inflation print. So the governor is absolutely right to acknowledge that the inflation rate will lift before it comes off. But it doesn't necessarily mean that their rate hikes, they need to be running hard against that, because they can't actually do much about that. They clearly think that they're in an uncomfortable place, and they're going to push the cash rate up to what they think is a neutral rate ahead of where we think neutral is. And I think the risk in all of this is that the RBA actually thinks that the economy can withstand a higher interest rate than we think is appropriate. And it's one of those things we're going to know when we get there. But our sense is that the Reserve Bank thinks that they can take the policy rate higher and quicker than we think is probably right for the economy, which is why we're going to be looking for quite a slowing into 2023.
Australia is sounding more like the US, where the concerns are that the Fed lifts so quickly that it actually pushes the economy into a slowdown and potentially a recession. Is there potential for that in Australia?
Look, there is. I mean, there's also the potential to avoid it because the RBA hasn't delivered it yet. And I think there's a lot of things that are different about Australia, which should mean we shouldn't go down that path, albeit that the decision yesterday runs the risk they're going to do that. But we simply don't have the wages growth that they have in the US at the moment. Our wages growth has actually been quite underwhelming to this point, even though we know the labour market's very tight. The other thing too is we also have a transmission mechanism from the cash rate to the mortgage rate, which is very, very direct. because the bulk of borrowers in Australia are on floating rate mortgages, whereas in the US, they're on these very long dated fixed rate loans. What I think that means is the Reserve Bank should not be running as hard against inflation as what their decision yesterday implies. But in a lot of ways, it doesn't matter what I think, it matters what they're going to do. And I think that decision to do 50 basis points yesterday is a pretty firm signal that in the near term, they're going to run hard against this. And I think that runs the risk they overcook it. And then we see in the data that things actually slow in a way that they're probably not anticipating.
Economics just got a whole lot more interest. It's always interesting, Gareth. I should be careful who I'm talking to here, but it got really interesting yesterday.
Look, it did, and it just shows how fluid the situation is right now. There's so much going on in the economy. We've come out of a pandemic into a booming economy that has clearly generated higher inflation, a very tight labour market, but suddenly we've now got a central bank not only normalising the cash rate, but seeming very intent to do it as quickly as possible now. And I think that makes our job trying to pick where things are going that little bit harder. But I also think it makes it tough for Australian households and businesses out there because they're not getting a lot of certainty here now on the policy front. They've gone from being under the impression rates weren't going up for a long time to then in May finding out rates have gone up by 25 basis points because that's a normal thing to do. Then suddenly they've gone up by 50 basis points a month later. And so there's a risk in all of this that households and businesses become quite concerned about the economic outlook simply because of what the Reserve Bank's doing.
Gareth, thank you for talking to Fear and Greed.
Great to chat, Sean. Cheers.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.